Alright, so we have a small group, and thank you for being here. I know spring break is coming up, so many people are probably busy with projects, finishing up projects, or studying for a midterm exam you have coming up maybe this week before spring break starts. So we'll get started anyway. So this is our last seminar of this series for Startup Launch. And let me turn this on. And we're right here, it's not March 10th, but we're right here, revenue model and fundraising we're talking about today. Our upcoming Innovation Week in the first week of April. So after spring break, just keep note of that. We have some speakers coming for AU Gather, or what usually used to be called Chapel, and some other Vespers, also the Kinetic and Proximity. And the pitch competition, that's going to be, the semifinals are going to be here. If you want to come watch, you're welcome to come and see what other people, or either businesses they're starting, ministries, nonprofits, whatever it is, you're welcome to come and watch the semifinals here on Wednesday. It's pretty much going to be going from like 9:30 in the morning until like 3 something that day. So you can pop in at any time and kind of see the percentage of what they're doing. And then from those semifinals, the top 7 will move on to the finals at the Howard on Friday, April 5th. And that's also open to the public. As a pretty, it gets pretty exciting type of event. People are actually competing for funds. First place gets $10,000 to launch their business. Second place, $8,000, and so on. So go support your fellow students on that date. Go cheer on them. We're also going to have an audience award. So as audience, as attendees, you'll get to vote if you want to, give more money to one project or the other. So that should be fun too. And also on that same week on Tuesday, during this time, Tuesday Choice Time, we're going to have what we call an Entrepreneurship Hangout. Any student is invited. We have food. You get to just connect more with other students who are interested in entrepreneurship and innovation, get to know what other people are doing. Not necessarily because you are going to do something, but just to learn what others are doing, and maybe that inspires you to do something in the future. Okay? All right, but for today, this is still pretty loud. For today, we are talking about revenue models, are talking about fundraising, and whether you are an entrepreneur or not, this may have some interesting things for you to learn. All right. So first of all, what is a revenue model? It's essentially a financial model that tries to predict what is the revenue or the income coming to your business, nonprofit, or ministry. And it also tries to predict the expenses that you may have. Right? So if you're starting a business, a nonprofit, a ministry, you want to be able to have some rough estimates of what is going to cost and what type of money you can bring in. Even if it's a nonprofit or ministry, you may have donors, bringing in money. So at any rate, for any of those cases, there is some sort of income versus cost, expenses equation that you're trying to balance. And for example, if you are thinking about revenue, you have maybe sales of products that you have in your business. Maybe there's some sort of subscription fee that you have. Maybe there's a service you're providing to customers, to your clients, to people, and all of those should generate some sort of income, right? And hopefully there's some growth from year 1, year 2, year 3, right? You're growing that organization and your revenue is increasing. Now, how do you project that revenue? It can be difficult, right? It's not always straightforward. Depending on what you're doing, It may not always be straightforward. So most people try to have some sort of assumptions in terms of how to project that revenue. But we'll talk about another way to do it called market validation for you to understand that a little bit better. Now, in terms of expenses, I'd like to break it down into 4 main categories of expenses that you can have. COGS is cost of goods sold. That's what it means. COGS essentially tells you how much does it cost to produce a product, right? So if you're manufacturing a product, or you're producing it yourself, or you have a manufacturer, there's some cost there. And usually it's around 35% of your revenue. So that's how you estimate that. Marketing cost, if you are trying to do social media marketing, selling, whatever the case is, there's a cost. But it depends what type of marketing you're doing, right? So if you're marketing to customers, so that's B2C, right? Business to client or to customer, usually marketing costs are higher, up to 15% of your revenue. If you're marketing to other businesses, right? So you're selling a product or a service to another business, maybe you're part of a supply chain, or you just simply have those type of clients, then your marketing costs can be much lower, right? Because these are partners that you can establish, and then after that, you don't have to continually be marketing to them. You just have to maintain that relationship. In terms of sales, you may have some sales representatives, and usually they take a commission of sales, so that can be between 5 and 10%, depending on your business. And then overhead, legal, accounting, administrative, customer support, all those are also a cost and expense for you. And 35% usually can be a pretty reasonable overhead cost, expense. And whatever is left after that can be, those are your profit, those are your margins. So if you look at the percentages we have here on this table, you can be somewhere between 27 to 10%. Okay, so for example, retail, if you have a retail store, your profits are usually pretty low, right? It's about around 10%. If you are selling software, especially software as a service online, your margins, your profits can be really high, 30% or higher, right? Because your company is very lean, there's not a lot of manufacturing, right? There's not a lot of cost for distributing a product. People just go online and download your software, pay a subscription for that. So your profit margins can be a lot bigger, but it just depends on the industry you're in. All right, so we talked about how do you estimate your revenue. Anyone has an idea? How do you estimate the revenue for a company or an organization you're trying to establish? How do you calculate that? You're like, well, I want to start selling shoes. How do you know how much revenue you can bring? It's a tough question, right? So one way, there are 2 ways that we want to talk about today. The first one is you look at the size of the market, right? How many, let's go back with the shoe idea. How many shoes are being sold every year? And you're like, okay, it's a pretty big market. And you try to say, well, if we take a small percentage of that market, this is how much money we could make. So that's one way. The other way is you go out and ask people. You go out and show your product to people and say, would you buy this? And depending how many people say yes, it gives you an idea of what percentage of the market you could get. Okay, so let's break that down a little bit more. So let's say, for example, you have identified a market for your product or service. And in this example, I'm using cross-country running shoes. And that market in 2020 was $7 billion. right? So that's a huge market. But let's say your product specifically is only for women, so that's about half probably of that market. So that puts you around $3.5 billion. That's the total available market. That's what SAM stands for, the total available market. But how much of that market can you really capture in the first 3 years of your business? There's a couple of ways to look at this question. The first way is maybe you are limited by your production and distribution, right? So maybe maybe you can only produce 1,000 shoes a month, right? So in that case, that is really the most you can attain, right? You cannot make more money than what the products you are making. Right, so you're limited by production and distribution, and that sometimes can be a pretty simple calculation. Right? Okay, we can only produce 1,000 of this product every month. So at the very most, at the very best, this is how much we can sell. Right, so that is probably, that's not a bad way to calculate it, but you still don't know how much demand there actually exists for your product. You only know how much you can produce, and it gives you a list, a max of how much you could sell. But it's not the best way to calculate it. And so another way people do is that they try to estimate a percentage of the market share. And usually this assumption is based on, maybe it's just on their gut feeling. Maybe they're trying to be very conservative and say, in this example, we can say, well, 1% of 3.5 billion, which is the women's market for cross-country running shoes, 1% of that is 35 million. Right? So you say, you know what? If we attain 1% of the market, we could sell $35 million a year in revenue. And that sounds like a reasonable thing to say, but why did you choose 1%? And a lot of people try to use some assumptions based it on how competitive the market is. If it's very competitive, even 1% is probably really hard to attain. If it's not competitive, then it maybe sounds reasonable. But again, the assumptions are still somewhat fuzzy, right? So another way to try to approach this question is, well, what do your potential customers think, right? So one way to do that is that you can create some sort of marketing type of material. We call it a one-pager. You create that, you have a picture of your product or some explanation about the service you're providing. Talk about the features, you talk about when you plan on releasing or launching your business. You place a price as well, so people have an idea what type of price you're talking about. Then you show this one pager to people, and you ask them the question. And you have to ask people who are in your customer target that you're trying to achieve, right? Don't go just ask anyone. For example, if you're trying to sell cross-country running shoes to women, go ask women who do cross-country running. Right? And they can tell you, they can say, no, I don't like your shoes, or they don't seem to be high quality, or they don't seem to be comfortable. And they can say, and then you can go back and say, well, 2 out of 10 people said yes. Right? So 20% of the available market we could obtain. They are interested in our product. Now, showing a one-pager, just kind of like a marketing material, it's a good start if you don't have an actual prototype of your product. But it's even better once you have an actual prototype. We call that an MVP, a minimal viable product. Then you can actually go and people can test your product, and they can give you a more reliable answer as to whether they think your product is valuable, whether they will buy it or not. Okay, so with this data, then you can make a better prediction, going back here in terms of your revenue streams. if your projections for the first 3 years, you can make a better prediction this way and say, you know what, only 1 out of 10 people that we talked to said they would buy a product for the price that we told them, and that means that, okay, that's 10% of the market we could probably capture. Eventually, right, that's the demand that exists, but in the first years we're limited for capturing that market in terms of the amount of investment we will have to make in terms of marketing to actually reach that market, right? So that you can have some sort of ramping type of process where you're growing from a few sales until you reach some sort of threshold in terms of your revenue sales. All right. Any questions on that so far? So let's transition really quick to a different topic, although somewhat related, which is the fundraising. How many of you here are thinking of launching a business in which you might need to raise funds, get investors or donors? Show of hands. 1, 2, possibly 3, 4 more of you. Okay. So raising funds can can sound like a very big challenge, and I think a lot of times it sounds challenging because we hear news about this company raised this many million, this other person raised this much money, and it sounds really challenging because we don't understand exactly how they're doing it, why they're being so successful, and we don't really know where to start in terms of fundraising. So again, it can sound very challenging, but in reality, if you understand where you are as a company, then it will be much easier for you to understand how to approach that challenge. Okay, so let's break it down by phases or stages. The first one being the pre-seed round funding. So this applies to, maybe you have a small team or it's just yourself and you're developing a business plan, you're just developing your business model, you're developing a marketing strategy, maybe you have a low fidelity prototype initially, or you just have a sketch of an idea. So that's where you are, right? You have a sketch of an idea, you have a business plan, or at least a rough sketch of a business plan, and you need more funding in order to go from a sketch to an actual, some sort of prototype that you can show people and get some more validation for your idea. So in that period of time, you need some initial funding, and this is called the pre-seed round. So those of you who are planning on or have participated in our pitch competition here on campus, this is where you guys are, right? So you are in the pre-seed round. You don't have a reliable prototype or a product for most cases. You don't have customers yet for most cases. And you would like to at least get a prototype that you can show to customers, potential clients, and get some validation for your idea. Right? So usually you're gonna raise funds from friends, from family, pitch competitions, your own money or your own time in some cases. Especially as college students, you're gonna put a lot of your time, sweat equity into it. And another option that you may have not considered before is called crowdfunding. How many of you have heard of GoFundMe? Right? It's very, very common for when you're trying to help someone in need or a nonprofit, they always use GoFundMe. And GoFundMe is an example of crowdfunding. Essentially, you post about the need and the plans on how much money you need, the plans that you have to use that money, and people just donate, right? They just donate from their own money, and you may reach or not reach your goal depending on what you have. And if you reach it, great. You may get $5,000 or whatever you're racing for, and then you can use that money and do whatever you were planning, right? So maybe you want to help some people in need, build a house in Central America, whatever it is. Right, so crowdfunding for nonprofit world, you also have crowdfunding for the for-profit world, and it works similarly in some cases. For example, Kickstarter and Indiegogo. How many of you have heard of Kickstarter? All right, so they work very similarly in the sense that the people who give you money through those platforms, they don't have equity, they don't have ownership in your company. They're just supporting you. And usually, as a founder, you reward them in some other way, right? You tell them like, okay, if you give $100, you'll get a free t-shirt of our company, right? Or you'll be the first in line to buy our product once it comes out. If you donate $1,000, well, you get to meet the CEO of the company, right? You try to reward your donors in some way, but they don't have any ownership of your company. So that's how Kickstarter and Indiegogo work. But there are other platforms such as WeFunder and Start Engine that actually work a little differently. On those platforms, people who give to your fundraiser, they get ownership of your company. I mean, if people give $100, of course they own 0.000 whatever % of your company, right? They own very little of it, but when you put all of those investors combined, you may be raising $50,000, $100,000, right? And all of those people will eventually, might someday benefit from if your company, does really well. They are probably not going to make a lot of, millions of dollars from their investment if they only put, $100 or so, but it helps you. So as a founder, as a startup founder, you can look into those platforms, Start Engine, WeFunder, and try to find ways to leverage them, right? To be able to raise funding. So pre-seed is anywhere between $10,000, which kind of applies for a lot of cases that we see from here on our campus, up to maybe up to $1 million, depending on the type of technology you're developing, of course. If it requires a lot of early investment, if you're trying to build a complex machine, trying to do nuclear fusion or something that you need, even at the early stage, you need a lot of money. But if you're doing something much simpler than that, software, a product, somewhere between $10,000 and $50,000 helps you move from an idea and a sketch, an early business model, to actually have a prototype you can show to people and get validation. So that's the goal of this round, a prototype that is validated, right? So once you go through that pre-seed round and you have a prototype that is validated, now you start an actual formal round of funding. And you go after angel investors, which are people, just regular people that may live in your area, and they either have some money they want to invest, or it's a group of them, they group together and they find opportunities to invest. But these people don't do this full time. They're just kind of, they're wealthy and they have some extra cash and they're looking for opportunities for investment. Those are angel investors. You have some VCs, venture capital. They like to go for things that are very, high risk, right? So, but with a very also high probability of making a lot of money on their investment. And you can also use crowdfunding even at this stage. Both Start Engine and WeFunder have options to raise even more capital. I was just looking at Start Engine earlier today, and some companies are raising $1 million up to $2 million, for this type of fundraising. And now you're at this stage, you already have a prototype with some validation for customers. And what the goal of this stage for you is, you want to reach, you want to get to have actual customers buying your product. That's the goal of this stage. So that means that you may need to take your prototype, your MVP, and improve it so you can actually start selling it. That means you may need to get a team to do some marketing, some sales, accounting, manage everything that's going on. And so you want to start generating some revenue. Right, so at the end of this stage, you started with just a very rough prototype, and at the end of this stage, you want to end with some sales, some revenue. And once you have revenue, and depending on how much will determine how much you can raise in the next round. But once you have some revenue, you can go after what is called a Series A funding. And the goal here is that you have revenue, but maybe you're not profitable yet. Right? You are not really making a ton of money, and if the money that you are making is not really enough to cover even your own expenses, so that means you need to scale, maybe set up a physical store, maybe grow your e-commerce site, whatever it is to take advantage of the economies of scale. Then that's the type of investment that you need at this stage. Right? So again, you have customers already, you have some revenue, but you're not profitable. And on this stage, you want to move from just having some revenue and some sales to actually becoming profitable at the end of this phase. So whatever funding you get, whatever investment you get, it allows you to scale, to set up more of a team, and be able to become profitable. And you have to issue a lot more shares to attract new investors, of course, but this is very common. I mean, the Series A fundraising is very common. Now, there's a lot more fundraising phases you can do after this. You know, people call them Series B, Series C, Series D. I mean, you can go all the way, as many as you need. But really at this point, you already have a profitable business. And the reason to raise more capital is maybe you want to enter a new market, maybe you want to go to another city and establish your business, maybe you want to attract a different type of customer. Maybe you want to acquire a competitor to control more of the market. So you already have established company that is generating profits, but you want to now dominate the market in some other way. And this is why you would need to do a Series B and beyond. Right? Usually you're raising 20 million or above at this stage. All right, and finally, after you have gone through all of this series, all these rounds of fundraising, you may want to three things actually. You may want to keep the company private and just operate as a private company. You just continue to make revenue. You get to take advantage of your profits. You keep growing as much as the market allows, and you maintain the company private. The second option is that you could sell the company. You could actually do that at any stage, and through any of the fundraising rounds. You could get acquired by someone else, and that's not a bad thing. When someone acquires you, usually that allows you to actually, take advantage of the time and the investment you put into this. So if you started with $50 in your dorm room, and now someone is acquiring you for millions of dollars, that's a pretty good deal. Of course, you probably have put at this time countless hours and years into this company. And the third option is that you can go public, right? So it means that now that you have all these investors throughout different rounds, and now you want to open up to the general public. So it pretty much allows anyone to buy stock into your company, to buy shares. And that means that the company goes public. You may list your company in the New York Stock Exchange or other stock exchange, and anyone can go and buy from your company, buy shares into your company. Right? How many of you own shares in a company? 1, 2, 3, 4. A few of you. Okay. All right. So you have already participated in this as investors. Of course, if you ever take your company to an IPO, that's a huge. I mean, this is years down the road. I I mean, this may take years for you to get your company to public offering. There's some major companies that it's kind of strange to hear when they're launching their IPO, because sometimes those companies have been around for some time and they're already very profitable, and it's kind of strange to hear that they're finally entering that IPO stage. But that just shows you that it's not something that you do right away. You probably want to wait until your investors have have time for the value of the company to grow. So that at the time of an IPO, a lot of your early investors, even yourself, you may want to sell some of your shares, right, to be able to actually cash into your profits. Okay, and so those are the different rounds for fundraising. I forgot to mention when we're back here talking about Start Engine. This platform is actually pretty interesting. You can actually, if you invest in a company through Start Engine, and this is seed round or even pre-seed round, you get ownership, you get shares into the company, and you can actually trade those shares. You can sell those shares even within their own platform. So they're creating this marketplace where early investors, it kind of almost behaves as a stock market, but it's an early investor stock market. So I thought that was really interesting. You may think that there may be some opportunities in this platform where you can be an investor, right? Invest into a very early stage company. It keeps growing. Maybe after a couple of years, the value of your shares has increased, and then you can sell that even within their own platform, right? Before waiting until public offering comes, years later. So I just thought that was an interesting place for that type of market. And also, it's actually a very good opportunity for some of you who may want to raise funds, especially if you're trying to raise anything above $100,000. You need some way to really have access to that type of capital. All right, so that is all in terms of the presentation. Do you guys have any questions in terms of both revenue models, in terms of fundraising, some of the fundraising basics? Any questions you have? We have a few minutes. All right, while you think about questions, we'll do you can check in for your co-curricular, those of you who need the credit. All right, so if there are no questions, then we're free to go. Enjoy your spring break. See you after the break. Remember that we have a pitch competition in April 5th. Make sure you join us for that.